Everybody, welcome to the closing beat. Happy Monday. There we go. I've been rearranging my stuff while I was gone there. Hope you can hear me. All is good. We are financial advisors here at Jazz Wealth. See, I even moved the mic out of the way so you can see the logo. It's called branding, right? Make sure you remember that. Anyways, we are financial advisors. We take our retirement planning or long-term investing seriously. We take ourselves rather lightly. So hope you enjoy that. We have a lot to talk about today. Not a lot. I shouldn't say a lot because typical Monday, you got your pullback started here. Mondays tend to be weak overall. Not as weak as this, but we'll deal with it. We'll talk about it there. But we've got a pullback that's continuing, which is a good thing, right? Is it not a good thing? Does anybody not like this pullback? I like it. Hey, last week's Wine and Wealth, Eric took over, did 5 mistakes that you see clients making in Nest Egg. Got a ton of questions, so now he's able to work through all of that. In the notes from Jazz, which I may show you guys in a little bit. I don't have it up at the moment, but I may show that. I did a really interesting theory, but which turned into statistics, right? What percentage of your returns come from the dividends that an index or a sector may pay out, and what percentage of your returns come from growth? So I thought, well, that's really cool because the utility sector for right now is the standout sector. So I wanted to show that to clients and be like, okay, what percentage of the returns would be just purely reinvesting dividends? Kind of a fascinating thing. So check that out. If you're one of our clients or a research member, you should have that in your inbox. Otherwise, it's in the dojo as well for you there. So let's get started. You see that red off to the right-hand side of your screen? That's a 2% loss on the day. And it didn't really, if I bounce over here, there was really no attempt for the S&P to try any late day buying. I mean, it was very broad selling throughout the day. There was nowhere to hide, really. And it was just consistent. There was no real pain throughout the day, no volatility. It's typical this time of year not to see volatility. And a way to show that to you, if you've never done this before, let me come over here. Well, yeah, this little guy's messed up. If we look at the SPY, I'll just go to like a 5-minute chart. See how throughout the day, and we'll zoom in here to get you started on the day. See, it was just kind of a perfectly nice trending down day. No whipping back and forth, no news that caused people to be happy for a moment and scared. Just a really low volume, below average volume day with consistent selling. Now, from what I shared with you last week that we had reached the 200-day moving average. We had reached the top of the downtrend. We had reached that overbought moment. It was also about 50% from high to lows there. And so there are oversold, I should say. And so there's good reason for a lot of people to believe that there was a pullback, and all that's just kind of playing out there. Now, if we look at only the S&P, I've got the SPY there. You could use any index ETF that you want to look at. We came into the week with 71% of all stocks in the S&P being overbought. Agree or disagree, that's the number, right? Over 71.8%. Today, we started with 66% because the market had already started falling. Nonetheless, the majority of stocks very much overbought. Same thing we were talking about last week. No reason to get excited and try to buy in there. Now, here's the question. If the market pulls back, where does it stop, right? So we know we have this resistance here, right? We know that we have the 200-day moving average. Where do we pull back to? What can we use for support, right? So the majority of the area is going to be, if you're using the SPY, right around the $400 area a share if you're using the SPY, right? That'd also be about a 50% pullback. It'd be right at the 50-day moving average. You see how all these things start to line up where people will convince themselves it's a buying opportunity. So we're making our way down there. We'll see. It's hopeful support at the moment, but it's unknown support, so you can't really say that that's a gimme. Okay. I mentioned the utility sector a minute ago. The utility sector is doing much better than most other sectors in the market. It also is the closest to making new highs. I shared that with our clients in the Notes from Jazz email. We had just made a new high in utilities. What? What a boring little sector, right? But look at it go. And I made the argument that a lot of it came from dividends. 67% of it came from dividends there, right? And so now we have this new high in utilities. I thought, well, let's take a look around because nobody really cares about utilities as a whole. Let's look at each individual sector and let's see the average distance of the stocks in that sector. You get what I'm saying? So if we look at just utilities and we put all those stocks together, there's like 24 of them, I believe. We say, okay, what's the average distance from new 52-week highs for those stocks in the utility sector? Why would we do that? What do we care about this for? Well, if we can identify sectors where stocks are still very much far away from their 52-week highs, then maybe there's not a whole lot of strength to be had there. Maybe there's not a lot of the sector rotation, as some people like to call it there. Maybe we should stay away. However, if we find that there's areas where stocks are getting closer and closer and closer to 52-week highs, well, we could just look at it like this instead of looking through hundreds of stocks, right? So here's an example. The blue line is the S&P. This is prior to today, so this number is going to be slightly different today, but you could update it daily. The S&P, the average stock in the S&P is 19.6% away from its 52-week high, right? So the average stock in the S&P is essentially still in a bear market, right? As you work your way towards the front here, there's the utilities I was talking about. Average stock in the utility sector is only basically 4% away from hitting a new 52-week high. Where's the action at? Consumer staples. Lately, consumer staples, industrials, real estate, energy, which is surprising that it's down this far. The weak areas there, the average stock in communication services. Now, some of this has to do with earnings that just came out from a lot of them, but down 32% from 52-week highs. So if you're looking for discounted stocks, you don't have to scan through a whole bunch of stocks to figure it out. You go, oh, they're all over here. The average stock's down 32%. Yeah, I'll go look there first, right? Average stock's down 28%. Okay, I'll go look over here first instead of digging through and flipping through charts and stuff. So rather interesting, right? In other words, these areas up here would be beating the market at the moment in terms of performance or returns away from 52-week highs, and these would be lagging behind. Now, it's up to you. You go pick what you pick what you like there, have at it, do your thing. But I just wanted to share that with you. So I have a little rant off topic there. Something you can use. All right, let's take a look here. So back to the S&P real quick. We should have this thing moving, cranking here. If you were to look around today, you are going to find that names like Microsoft, big weighted stocks, Microsoft, Alphabet, Apple, you would even throw in Amazon, Tesla, the names that we normally talk about. All bad days. We do not have to go through individual stocks today because the whole market just decided to move lower. You have like a couple consumer staples like Constellation brands were higher. What was it? Kroger. Kroger's always higher when the market's lower. Isn't that funny? That was pretty much it. You know, I mean, a couple energy stocks just looking around there, but otherwise it was broad to the downside. I don't have to beat that one to death, right? The NASDAQ easily back into bear market territory today. It's now down 21% year to date. Over the last week, if you just want to say, hey, let's go back 5 days, you're averaging 5%, 1% a day over the last 5 days. Just a touch more than that, actually. I will point out Apple. I've been getting a lot of questions on Apple. Hey, Apple's had a great run. It's up over 30% in 2 months. Is that a good thing? Will it pull back and prove to be buyable pullbacks, or will Apple pull back and prove to fizzle out and that will be the end of it? Well, I don't know. But I do know that we can look at how often this has happened, and this has happened a lot. Apple to rally 30% in a rolling 2-month period. Just start at any point, go 2 months forward and go, was it 30% higher? Yes or no? No? Okay, next point, and do that. It's actually very normal. Take a look. So you can go into our research site, or if you're a client, this is also available to you there. In any rolling time period, again, this is rolling 2-month period, 266 times you could pick out a spot where it had rallied 30% in a 2-month period. The forward performance shows that the momentum continues. There are certainly pullbacks in there, but the average return 2 months forward from this happening is 7%, median return 7%, positive 65% of the time. You can, I believe we can sort these numbers here. Let's go like this. Yeah, so here's the, this would be the returns going forward from having a 30% gain in a 2-month time period. Mostly positive. Here's some bigger names in there. That didn't sort the way I was hoping it would sort. But you got some bigger returns in there. Remember, it's a rolling search. So very fascinating. And I did not do that. You can use this down here if you want. Send it to the forward lookup and basically just put any time period you want in there. I didn't do it. I didn't bother with it yet. But so the moral of that short story is, yeah, Apple is working on a pullback that over the long run you might want to consider as being buyable. Where? I don't know. That's the tough part, right? You kind of just got to watch it day by day. Anyway, something different for you there. I rambled a lot today. Let's do some stocks in the news, huh? Then I'll take your questions. Well, we'll just stay here with Apple. Employees don't want to go back to work for Apple there. They are fighting back on Apple's policy to get people back to work, and Apple's already delayed the comeback to office before, by 2 months, was it? So they're dealing with some of that there. I don't know. Go back to work. Go back to work. Bed Bath & Beyond. I feel no pain for people that decided to participate in these things. Bed Bath & Beyond. Last week we were talking about this shooting up for absolutely no reason. Over time, the smarter investors decided to put out their notes and go, yeah, we're selling. We're smart. We're going to sell. If everybody wants to buy, we're going to sell. That's continued today. And I believe that some retailers or some of their suppliers to this retailer have decided to stop delivering to them for fear they may not get paid. Understandable, right? That's a tough one. What do you do with it now if you fell into that meme trap thing? I really dislike that. I also dislike E. coli. Throw that out there. Wendy's is basically going to be throwing away a bunch of lettuce that had E. coli in it. It was mostly in the Midwest if you're a Wendy's fan, but I think I'll stay away. Tesla, there you go. Tesla, what is the, Harry, what's it called? The full driving, there's a name for it. For the thing to fully drive itself, the car, price is going up, basically. There's a name for it. I'm not familiar with it because I'm not a Tesla person. Starting actually, wow, that's coming up soon. That's coming up September 5th, it looks like. You're going to have to pay like $15,000 versus $10,000 or $12,000 or whatever it was. Good for them. I don't blame them. I would do it too. And Signify Health, you may have noticed, come up on any scanner today. Every single scanner for volume, for price action, percentage gain, 52-week highs. It just came up on all of them today because apparently Amazon is looking to bid for them. But I believe CVS and United Healthcare already had bids. I saw this a while back. I may have gotten the names wrong there, CVS and United Healthcare, but that's stuck in my head. But otherwise, Amazon is saying, hey, we're in. Right? We're thinking we would bid as much as $8 billion. Woo-wee. And then you have AMC, another one of those meme stocks falling apart today. It's down 41% in a day. Great. GameStop as well. Actually, GameStop held up. But just stop it with these things, huh? Just stop it. Come on. Oh, full service driving. Thank you for that. Appreciate it. You think Bed Bath & Beyond's going to do it? Okay. I don't know. We'll see. Only have the Wendy's freeze. I had Wendy's fries the other day. The little one went out to go get food, and she brought me back fries. And I was like, okay. Yeah. Meme madness drives me crazy. Okay, I'll take your questions if you have any there. Otherwise, tomorrow you have Dick's Sport retailers, right? It's retail earnings season. So if you own retail stocks or you're heavy in a mutual fund that's heavy in retail, you want to pay attention because you got Dick's Sporting Goods, Smuckers, Macy's, Advanced Auto Parts. Where's my list? Lazy Boy, Nordstrom, and Urban Outfitters. Toll Brothers reports too, by the way. And Toll Brothers has the best earnings results out of all the names tomorrow. Yeah, better than Smuckers as well. Smuckers does quite well. And Toll Brothers has only been down 2 of the last 8 earnings reports. Let me make sure I got that right because... no, sorry, I got that wrong. 4 of the last 8 has been down. A little screen was cut off. So your best ones tomorrow actually are Intuit, Strike that. Go back all the way to where I was just talking about. Intuit is your best reporting stock tomorrow. 85% of the time beats on earnings. Only 2 of the last 8 earnings days did the stock trade lower. Other than that, it's been higher. That's your best performer there. Very close second is Macy's, surprisingly. But that all will come out tomorrow. You have Fed, what is it? The Jackson Hole meeting coming up here. So everybody's looking to see how aggressive the Fed will speak. In particular, it'll be Jerome Powell that will be doing the speaking. Hey, with a name like Smuckers, how can you not like it? You know what I mean? You're not sure if Toll Brothers can report good stuff, home builder. Remember, Toll Brothers was one of the first, though, to say, we're going to pull back and not continue building. We're going to hold on to some of our inventory in terms of lots and land. They were the first to do that, like mid-2019. Very kind of genius on their part. Yeah. Why isn't anybody talking about quantitative tightening? That's going to destroy the market. The word quantitative tightening hasn't been used much. I'll give you that. But yeah, that is something that has been talked about a lot. They just don't use those words. You think August will finish out choppy or smooth after Jackson Hole? Well, that is pretty much all we have to look at for the rest of the month. So it's really, again, up to one man. Is Occidental Petroleum one of those plays where you can buy before Warren actually makes a formal bid for the entire company? I don't think he's going to do that. I could be wrong, but I don't think he's going to bid for the entire company ever. But you could buy the stock anytime you like. Yeah, nobody's going to stop from that. Yep. All right. We have done what we needed to do today, right? We did. All right. Tomorrow, I'll be back. We'll do this all over again. We have a little more action coming, it looks like, in the oil markets with the inventory numbers coming out this week. Should be more interesting with what happened over the weekend. We've got the bond market all over the place. Rates moving higher even again today. So we'll be covering that and much more. Wipe off the Monday dust in my head, and I'll see you guys tomorrow. Adios.